This is the trend scalping strategy that works shockingly well, and the key to its success is a consistently high win rate that allows small, frequent gains to compound into exponential portfolio growth. Many traders struggle because they rely on lagging indicators and become victims of the constant false signals that plague lower time frames, especially during choppy market conditions. The single universal edge that separates high-performance trend scalpers from the rest is a robust multi-timeframe trend confirmation system, which is then coupled with a precise pullback entry filter. We're about to break down 3 specific rule-based strategies that are proven to deliver this high win rate, moving beyond theory into actionable trading systems. Our first powerhouse system is the triple exponential moving average pullback, a setup specifically designed to capture momentum in established trends while filtering out the noise of minor retracements. The core of this high win rate setup relies on 3 distinct exponential moving averages to define the trend structure and guide our entry. We will be using the 25-period exponential moving average, the 50-period exponential moving average, and the 100-period exponential moving average, all applied to the 5-minute chart for optimal scalping velocity. This combination of moving averages provides a dynamic map of the market's short-term, intermediate, and longer-term biases within the scalping time frame. The trend confirmation rule for a long bias is straightforward and must be rigidly followed to ensure we are trading with the path of least resistance. The 25-period and 50-period exponential moving averages must both be clearly stacked above the 100-period exponential moving average, which signifies a strong and healthy uptrend. Conversely, for a short bias, the 25-period and 50-period exponential moving averages must be positioned beneath the 100-period exponential moving average, confirming a dominant downtrend. This stacking relationship is the first and most crucial filter, ensuring that we never attempt to scalp against significant market momentum. It provides the necessary higher time frame context, even though we are only looking at the 5-minute chart. The entry signal is where the pullback aspect of the strategy comes into play, utilizing the exponential moving averages as dynamic support and resistance zones. We must patiently wait for the price action to retrace back to the area of the 25-period or the 50-period exponential moving average, showing a temporary exhaustion of the primary trend. The actual entry is executed only when the price resumes the trend direction and the candle closes back outside the 25-period exponential moving average, confirming the rejection of the support or resistance zone. This closing price confirmation is vital, preventing premature entries on false reversal attempts and ensuring the trend has genuinely reasserted itself. Understanding the mechanics of the pullback is essential for successful execution of this strategy, as it represents a brief moment of market inefficiency. The 25-period exponential moving average acts as the immediate shallow pullback zone, often signaling the strongest trends that barely take a breath. The 50-period exponential moving average serves as a deeper, more significant support or resistance area representing a healthier market correction. If the price pulls back all the way to the 100-period exponential moving average, it often signals a potential trend exhaustion or reversal, and we should typically avoid taking a scalping trade. This nuanced interpretation of the moving average interaction is what elevates the strategy's win rate. We must now discuss the critical component of risk management, which is non-negotiable for a high-frequency scalping system. The stop-loss placement is strategically set at the 50-period exponential moving average when entering a trade from the 25-period area, or slightly beyond the 100-period exponential moving average for a deeper entry, providing a logical market structure-based exit point. This placement ensures that if the intermediate trend structure breaks, we are immediately out of the market with a minimal loss. The take-profit target is always aimed for a conservative 1.5 to 1 risk-to-reward ratio, recognizing that scalping prioritizes high probability over massive profit per trade. The 1.5 to 1 ratio is chosen because the triple exponential moving average pullback system is designed for quick, decisive moves, meaning we sacrifice a larger potential reward for a much higher likelihood of hitting the target. A higher risk-to-reward ratio, such as 2-to-1 or 3-to-1, would significantly reduce the win rate, which defeats the entire purpose of this scalping methodology. Consistent, small wins that protect capital are the goal, allowing the power of compounding to generate the substantial long-term returns. Discipline in taking profits at the target is just as important as discipline in setting the stop loss, preventing winning trades from turning into losers. Moving to our second powerful methodology, we introduce the Statistically Proven System, a robust method that combines multiple indicators for rock-solid confirmation. This strategy is known as the Exponential Moving Average plus Supertrend plus Momentum Filter, and it has a verifiable history of impressive performance. The specific proof comes from a backtest that achieved a solid 64% win rate over a sample of 155 trades, which is an exceptional figure for any mechanical trading system. More impressively, this backtested strategy generated a 139% profit gain in just 4 months on a small account, validating its shocking effectiveness in real-world conditions. The indicators for this high-performance system include a single exponential moving average, which acts primarily as the overarching trend filter, providing the baseline context for market direction. The Supertrend Indicator is then utilized to generate the primary buyer-sell signal, offering a clear, unambiguous signal when the market shifts momentum. Finally, the Price Momentum Oscillator is employed as the essential momentum validation tool, ensuring that the signal from the supertrend is backed by genuine market strength and not just a minor fluctuation. This three-part confirmation process ensures that only the highest probability setups are traded. The three-part confirmation rule is the backbone of this statistically proven scalping strategy, demanding perfect alignment across all three indicators. Before an entry is considered, first, the price must be trading above the exponential moving average for a long position or below it for a short position, establishing the primary trend direction. Second, the Supertrend Indicator must simultaneously confirm the buy or sell signal, flipping its color and position to align with the desired trade direction. Third, and critically, the Price Momentum Oscillator must produce a zero-line crossover in the direction of the trade, validating that the underlying momentum is strong enough to sustain the move. The Exponential Moving Average trend filter is the first and least flexible condition, ensuring that we are always trading on the right side of the intermediate market flow. If the price is hovering near the exponential moving average or crossing back and forth, the market is likely in a consolidation phase, and the strategy should be shelved until a clear separation occurs. The Supertrend Indicator provides a dynamic stop-loss level and a clear visual signal, making the entry decision objective and removing the need for subjective interpretation. Its ability to track volatility makes it an excellent companion to the standard exponential moving average. The Price Momentum Oscillator is the final non-negotiable piece of the puzzle, acting as the ultimate quality control filter for the trade setup. A zero-line crossover on the Price Momentum Oscillator is a powerful confirmation that the market's internal pressure is building in the direction of the trade, suggesting a high probability of follow-through. If the first two conditions are met, but the Price Momentum Oscillator has not yet crossed the zero line, the trade must be ignored, as the momentum required for a successful scalp is not yet present. This strict adherence to the momentum filter is a primary reason for the strategy's high 64% win rate. The critical entry note for this system is an absolute rule that separates profitable traders from those who chase every flicker of movement. You must wait for the signal candle to close before entering the trade, regardless of how enticing the move appears mid-candle. Entering before the close is a common mistake that leads to getting caught in wicks and false reversals, as the signal can easily disappear in the final seconds of the candle's formation. Waiting for the confirmed candle close ensures that the supertrend signal and the Price Momentum Oscillator reading are solid and locked in, providing a high-quality, validated entry point. We now transition to Strategy 3, which leverages a specific predictable market phenomenon, the time-specific high-volume edge, often referred to as the opening range method. This strategy exploits the inherent volatility and directional commitment that occurs at the beginning of a major trading session. The specific time fact to anchor this strategy is that the first 5 minutes after 9:30 a.m. Eastern Standard Time, which is the opening of the New York Stock Exchange, consistently have more volume than any other 5-minute period of the entire trading day. This massive surge in volume represents the highest concentration of institutional and retail commitment, making its initial direction highly significant. The foundation of this strategy is built on the understanding that the high and the low of that initial 5-minute candle represent the maximum buying and selling pressure of the highest volume period of the day. This initial 5-minute range acts as a critical line in the sand, a battleground where the day's primary direction is established by the most powerful market participants. Scalping this range breakout allows us to ride the initial momentum wave created by the influx of opening orders and news reactions. This is a pure price action strategy, requiring minimal indicators but maximum focus during the opening minutes. The direction confirmation is achieved by waiting for the price to aggressively break out of this initial 5-minute range, which is the immediate confirmation of the market's directional commitment for the current session. A decisive candle close above the high of the 5-minute range signals a strong bullish bias, while a close below the low signals a strong bearish bias. It is crucial that this breakout is aggressive and not a tentative, small-bodied candle, as we are looking for a clear commitment from the high-volume players. The market rarely reverses immediately after such a strong, high-volume directional move. The high-quality entry, which we often call the gift, is the key to maximizing the risk-to-reward profile of this opening range scalping strategy. Instead of chasing the initial breakout, which can be volatile and lead to poor entry prices, we wait for the price to pull back to retest a key level. This key level is typically the breakout level itself, the high or low of the 5-minute range, or a nearby powerful liquidity zone like a fair value gap that was created during the initial aggressive move. This patience allows us to enter the trade with a significantly tighter stop loss. The concept of the fair value gap is a critical element to understand for this entry technique, as it represents an imbalance in the market's price delivery when the price aggressively moves in one direction, leaving 3 or more candles without overlapping wicks. A fair value gap is created, and the market often seeks to fill this imbalance before continuing the trend, entering only when a reversal candle or a strong confirmation candle forms at that retest zone, whether it is the breakout level or the fair value gap, maximizes the probability of a successful scalp. This strategic weighting transforms a high-risk breakout trade into a high-probability pullback trade. The opening range breakout scalping strategy is highly specific to the time of day, making it a very time-efficient system for traders with limited hours. By focusing all energy on the 9:30 a.m. to 10:30 a.m. Eastern Standard Time window, a trader can capture the highest probability moves and then step away from the charts, avoiding the lower volume chop that often characterizes the middle of the day. The discipline required for this strategy is to absolutely avoid trading outside of this high-volume window, as the conditions that make it work simply do not exist at other times. The volume is the ultimate indicator here. We now synthesize these powerful concepts and reveal the shockingly simple secret that underpins the success of all 3 of these high-performance scalping strategies. The true power is not found in the specific indicators themselves, but in the mandatory, unyielding rule of aligning a lower time frame entry, such as the 5-minute or the 1-minute chart, with a higher time frame trend, specifically the 1-hour or the 15-minute chart. This multi-time frame alignment ensures that your micro movements are always supported by the macro market structure, significantly reducing the chances of entering a counter-trend noise signal. The 5-minute chart shows you the immediate opportunity, the trigger, and the precise entry point, while the 15-minute or 1-hour chart dictates the underlying market bias and direction. For instance, if the 1-hour chart shows a clear uptrend, you should only be looking for long entries on the 5-minute chart, even if the 5-minute chart briefly shows a small downtrend pullback. This simple discipline of checking the higher time frame first eliminates the majority of false scalping signals instantly. It is the core edge that all professional scalpers employ, and it is the shocking secret to consistent profitability. To ensure success with these powerful strategies, there are mandatory rules for success that transcend the technical setup and delve into the necessary psychological discipline. First and foremost, you must adhere to strict risk management principles. Never, under any circumstance, risk more than 1% to 2% of your total trading capital per individual trade. Scalping inherently involves frequent trades, and a single large loss can wipe out weeks of successful small gains, so position sizing must be meticulously calculated before every single entry. Protecting your capital is the ultimate goal in high-frequency trading. Second, the discipline required for scalping is immense, demanding the use of a tight stop loss, typically placed 5 to 10 pips away from the entry, and the ability to take profit quickly. The profitability of these systems relies entirely on a high win-to-loss ratio, meaning you cannot afford to let winning trades run into deep pullbacks or become losing trades. You must be content with the small, consistent profit target and be ready to exit the trade as soon as the target is hit, which requires overcoming the natural human tendency towards greed. The goal is to capture the initial high momentum thrust and then immediately move on to the next setup. Third, the selection of the market and the trading time is just as crucial as the entry signal itself, requiring you to trade only during high-volume, highly liquid sessions. The best time to employ these scalping strategies is during the London and New York overlap, which is generally from 8 a.m. to 12 p.m. Eastern Standard Time. High liquidity ensures that your orders are filled immediately at the desired price, minimizing slippage, which is a silent killer of scalping profitability. Trading during low-volume periods, such as the Asian session, will introduce unnecessary risk and unreliable indicator signals. The combination of the multi-timeframe trend confirmation, the specific entry filters of the 3 strategies, and the strict adherence to these risk and discipline rules is what transforms an average trading strategy into a consistently winning system. The simplicity of the underlying principle, trading with the major trend, is masked by the complexity of execution, but mastering the rules makes the execution mechanical. Remember that the market is a probabilistic environment, and your job is to stack as many probabilities in your favor as possible before committing capital to a trade. These 3 strategies provide 3 distinct high-probability ways to achieve that stacking. The final powerful takeaway is that consistent execution and unwavering discipline are the true factors that transform an average strategy into a winning system with a shockingly high success rate. The indicators are merely tools. Your mindset is the ultimate edge. By aligning your lower time frame entry with the higher time frame trend and strictly adhering to your risk management rules, you are giving yourself the best possible chance for long-term compounding success. Master these 3 strategies and you will unlock the shocking power of consistent trend scalping.